Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments and subscribers. I greatly appreciate it. This week up, we're going to take a look at Citigroup. Behind me is their most recent annual report with their $2.2 trillion of assets. Let's figure out how much cash money Citigroup generates and if we should buy the stock or not. Ready? Let's get to work. All right, behind me is the Citigroup's annual report. Remember, filed December 30th, 2020 is their fiscal year. Let's go through and take a look at kind of the business as itself, how it stands, where they get their money from and clients, what the income statement P&L looks like. We'll look through this really quickly, then we'll go to our dashboard. Before we begin Citigroup, I want to review the 5 key attributes, but instead of 5, we're going to do 3 because these are banks. Banks are not like a typical company. There is no EBITDA in a bank, and unfortunately their product is cash, so it's very hard to figure out which cash is generated by operating the bank versus customer deposits and loans that they've made to customers, right? Their product is cash, and we measure cash flow, so it gets commingled. Cash is fungible. So what are we going to do? We're going to look at revenue as number 1. We're going to look at net income for number 2, and we're going to look at price to book value as our relative value metric. We're also doing our normal forecasting and see what we think we can earn by owning this investment long term. But we're going to do those 3 characteristics in this bank series we're going to go through. All right, let's get to work and go through this Citigroup annual report. One thing I do want to point out is how banks measure revenue. So typically you'll see a summary like this. They'll say net revenue $74 billion. But I'm going to use a number that's slightly adjusted to that. So this is the number that they'll state, but there's loan losses and provisions for loan losses, which they don't even have on here, that I net when I do revenue. So I'm taking this minus whatever their provision is for loan losses. I want to see what that looks like. Next thing for net income, well, let's go to the P&L, take a look at it. Michael Corbett here is the executive. He is leaving as the head of the bank, replaced by Jane Frazier. She will be taking over. In fact, she's taking over already, putting a new stamp on the executive leadership, kind of a new mantra going forward. Behind me is a quick breakdown of the business of Citigroup. So 50% of their business comes from North America, another 17% from Europe, Middle East, and Africa. You've got 21% from Asia, the rest being Latin America, 12%. That's overall their makeup. Half coming from North America. On the business side, you've got the global customer banking, this traditional bank that you would think of it, 40% of the revenue. ICG, that's the commercial banking division, that's 30%, so another banking. And then capital markets and securities, your investment banking services would be there, that's 30%. So fairly diversified. However, you look at banking as a total, it's roughly 70% of their business. So global consumer banking and then corporate banking, like as a CFO, if I want to use the treasury services of a bank to manage the cash within a business, that falls in here. It's outside of commercial banking. It's inside the professional banking world, the ICG, institutional clients, excuse me. Okay, so here we go. Let's take a look at their income statement and figure out how much revenue and cash they generate. All right, behind me is the P&L for Citigroup. Now I want to walk through how to read a bank's financial statement because again, cash is fungible and their product is cash, so we want to be able to separate out what's the cost and what's the revenue. The way banks state revenue is they'll have interest revenue. That's revenue they get from lending the cash out. If you get a mortgage with Citigroup as an example, you pay interest. That is their revenue. Interest expense is the amount of money that they have to pay on deposits to customers whose cash is in their bank account. They net those two. In this instance, there's $43 billion of net cash that they get, or net income that they get, from the difference between the interest rate that they can bring in from loans to the interest rate they pay out to customers. They've got a bunch of other costs here, commissions, principal transactions, and so forth, and you get non-interest revenues of $30 billion. That would be investment banking fees. So IPOing a company, a bank has a right to buy shares of the IPO as part of the underwriting package. On top of the fees that they collect, that is roughly, what's that mental math, 40% of total revenue, 74 divided by 30. And you can see that holds pretty well. That's a sizable chunk of their revenues coming from that division. Total revenue, $74 billion, largely flat the last 3 years. In this robust economy that we're having, 73 billion, 74 billion and 74 billion. So that's pretty flat. What I do when I look at revenue is I want to take this line and I'm going to net it against this one here, provisions for credit losses on loans. That is basically they made a loan to a party and that party defaults and doesn't pay them back, or they don't get 100% of their money back. In this case, I want to take these two and I'll net the two. So this becomes like 58, that becomes about 66, that becomes about 66 as well. So you get a revenue number that's adjusted for the underperformance of loans that they've made. And then we want to take a look at that. Next thing we want to look at is net income. So I'll come all the way down, net income here. They got a couple net incomes. Now, one important thing to know about banks have preferred stock. What is preferred stock? Preferred stock is a hybrid between a debt security and an equity security. We, as investors, as cash flow investors, buy common stock equity in a business. The bank will insert a preferred stock in the capital structure of a business between the debt and between the equity to raise more cash they can use to lend out. Now that preferred stock is an equity position but is in front of the common stock and is owed a dividend, whether they call it a coupon, but it's owed much like a debt. So if it's not paid, it accrues like a bond, whereas a dividend to a common stock owner is not an obligation. It's more of a grant. They're not obligated to pay dividends. They're obligated to pay the coupon on a preferred stock. As a result, I'm going to include that in my understanding of what a debt is, or our assumption of what a debt is. Because as common stock owners, if the bank were to go out of business and we go in front of the judge in bankruptcy court to get our cash back, the judge is going to pay back the preferred stock owners before it pays back the common stock owners. So for me, in my capital risk, that's a risk of not being paid back. So the preferred stock is in front of the common. I'm going to take this net income here, right there, $11 billion, and I'm going to subtract the preferred coupon out of that. So I get an adjusted net income that's after the preferred dividend, basically the net income that's truly available to common stockholders. Okay, let's take a look at the financial information in a historical perspective for Citi, and we'll figure out what we want to do with this information. Again, we're going to start with book value. So the first thing we need to book value is we need total assets. Total assets here on the balance sheet, just pull the total assets number, and I get $2.2 trillion, which is a lot of jack, by the way. That's a lot of jack. But it hasn't grown all that much. So in total, the CAGR, 2.4% annual growth in total assets, from kind of a low of 1.8 or even the mid-year 1.7, 1.8 to 2.2 trillion. Less goodwill and intangibles, less total debt and preferred stock gives me a book value number of tangible book value for Citigroup. And what you're going to notice here is wildly mediocre. 155 billion to 153 billion. That's a negative 0.1% growth rate. Essentially flat. That is flat. Just rounded zero. So when we're looking for something that's growing, already I'm seeing a little bit of a concern that they're a monster bank. They're kind of diversified. Don't seem to be able to grow in my book. So this growth rate for me isn't really checking the box in terms of capital appreciation that would come from a larger net book value. But let's figure out what kind of value we've got here and move forward. Share price that's book value per share. That's just me taking this number divided by to the average shares outstanding, and you can see that's growing nicely, $51 billion to $73 billion. And what you're going to just instantly realize there, if book value is flat, my numerator in the equation is flat, this number here. But this product is growing. That means the share count here must be shrinking. So I bet you anything they are buying back their shares, which is driving this growth, which is driving the stock. So their stock price is probably moving based on the reduction of shares outstanding, not that the business itself is growing. Let's take a look at market cap. Market cap, pretty flat, actually. It kind of spiked up here at 200 billion. low of 150, but low of 120. All in all, not moving too much. And you'll notice here we've got a price per share or book value per share. That's generally how a bank is valued on its net book assets relative to the purchase price. And it sits roughly around one times average. It may not drift that far away from that number. So at a premium would be 1.3. Looks like a big discount would be 0.8. So not a whole lot. And if I expand those decimals a little bit, see if it changes anything. So 0.84 is probably the low point. 0.77 after the financial crisis. Citi had a lot of problems. Financial crisis of 08. So even in 2012, which is the very first line here, there was a lot of turmoil in the real estate market, still a lot of disintegration in the market. So I would assume that's why it was so low. After that, it seems like it's recovered, hasn't really fallen back down that much. So we'll use 1 times as a book value going forward. Let's take a look at revenue. Let's take a look at net income and figure out how much revenue, net income they generate and what they're doing with their cash. Okay, let's take a look at revenue for Citigroup. $58 billion in 2012, $58 billion in 2020, flat revenue, largely in line with flat book value. This number doesn't include $16 billion of credit losses. I've adjusted down the net income, the revenue to account for increase in the losses on their book. But I think even adjusting that back, you're basically at 66, which has been the same range that they've had for many years. So the growth here is definitely low. When I look at net income is all over the place. It's kind of super low here coming out of the financial turmoil. It kind of reverts to what I would call as a normal range in here, skipping this negative. That seems to be a normal range. And then this $10 billion here is a result of, like I said, the operating losses. I think it's a one-time adjustment. Their normal rate is about $8 billion. So if in 2020 we added, they had a $16 billion write-down. It's normally 8. That's $8 billion of additional write-offs. Well, 10 plus the 8, if you normalize, that gives me 18. That means I'm roughly flat to the prior year. So, growth here is tough to measure. So if I look at a broader period of time for growth, I can take this number here and average these 3 years. I can average these 2 years as kind of normalized rate. That growth rate is actually 12% annually across these period of time, which is a healthy growth rate. But I don't think you can maintain that on zero revenue. So going forward, I'm not going to give it 12%. What I'll probably do is take this 3%, I'm going to round it up to 4 and run that as a conservative forecast because I don't know how they're going to grow the top line. And you can't always increase the bottom line without some top line movement. So I'm going to give a nice conservative 4% growth going forward and net income, see what that does. But let's keep going forward and figure out what we get. So net income is small growth. This is what I wanted to show you, the share count. 3 billion shares to 2 billion. They've removed a third of the outstanding shares, which is incredible in terms of what they've been buying back. No wonder the book value has been going up every year because they've been chewing up their own stock. They have not been growing earnings and revenue. So that to me is a red flag. That is a company that is kind of manipulating in a good sense, but they're manipulating the number by changing the denominator and not really growing the general business. So for me, I like seeing that, but I also want a business that's growing revenue and earnings. Right? That's our trifecta if you can find it. So for us, it's nice to see, but it's not the entire picture. Earnings per share, price, and a yield. Average yield here is 7%. If you get it in the double digits, it's a solid buy. 7% seems to be the long-term average for me. Okay, now let's figure out where we are. Let's recap a little. Revenue is flat. Earnings, weak growth. Book value is average 1. I think right now it's trading roughly, slightly below book value. So we'll see what this does for the forecast. Okay, let's forecast going forward. So I'm going to pick up book value and I'm going to grow it at the historical book value, which has been flat. There's really nothing to do here. If they haven't been able to grow in this robust market, I can't just assume they're going to grow more. So I'm going to hold this roughly flat. I'm going to give them a little bit of market multiple expansion. So I'm going to assume they're going to get to 1 times. They're currently, or at least last fiscal year, 0.8 times. That means on average, the stock should be about $72 in value. And that makes sense because there's not much growth here and the market multiple expansion is relatively low. So this is pretty much where it's trading at now, $72. Let's take a look at net income. So if I look at earnings per share and I try to forecast earnings per share, I'm going to pick up on the net income growth that I've used 4%. And I'm going to assume that there's no other share dilution or their share buybacks. So they're going to spend all this cash as a dividend to me. But you get a pretty good earnings net income yield. Again, this isn't cash flow, this is net income, but it's still a relative value metric. They could dividend a lot of this money out. If I apply an average 7.1% yield to it, which is the average that we've experienced, I get a $130 value, which is a sizable difference, almost a doubling of where it is currently. So what do we have here? We've got two different values. We've got $72 on a book value basis, which makes sense. Book value has not been growing, and market multiple expansion is very, very small. I've got a pretty solid growth on an earnings yield basis because I'm assuming they can continue the 4% growth over time, which is risky. I give you that. Certainly if they can't grow revenue and they can't grow book value. So I'll split the difference, which I think actually covers some of the risk on the 130 by bringing it down to about $100 long term. And when I plug that into an IRR, I get a pretty decent return. So I'm in for $72, which is roughly what the stock trades at today. I get a cash flow net income, if you will, for a stock over time that they could buy back shares, they could dividend out to me, they could use to acquire other banks, which is actually a strong, almost double-digit yield. If I'm buying at 72, I'm making 6.5. What's that? 7% yield or something like that. That's a pretty decent yield over that time frame. Plus, I get capital appreciation on my investment, not too shabby. And then in the end, that stacks up to be a 15% IRR, which is a healthy return on a very conservative assumption for a bank. Certainly that I've haircutted the $130 price tag target because I'm averaging the two assumptions. So I think this is actually pretty attractive at a 15% return. If I put this into a distribution, I'm at $72 right now at this stock price at 15% IRR. If the stock goes up to the 90s, I'm out. It's not worth it. Too much risk. But if it does come down for some reason, if interest rates move and the stock price falls, I think Citigroup is a good buy. Certainly less than $70 a share. I'd be looking into it. So we're going to give it on this channel a good, given the conservative assumptions that we have outlined. It's not the greatest stock. It's not like a fantastic high-flying tech subscription company. It's just a different piece in the portfolio. But for the mega cap bank stocks, to be able to find a price of one that's going to yield what could be an above market return. Right, if the market is going to return 10% on average, this thing could yield 15%. That's a 50% increase in the market return, which is fantastic. So I think for a massive bank with lots of analysts looking at it, to be able to find something over the long term could yield like that is a good risk return ratio. Let's review our three key attributes for Citigroup. Number one, top line revenue growth. It's flat. It's not there. Number two, earnings growth, net income. Net income is there. They've been growing the net income. And then the well-priced, the price to book value. The price to book value is below average and returns an above market return, even with the flat revenue growth, which I think is really interesting. So when I put conservative assumptions forth in terms of earning growth, book value growth being zero, it returns an above average return to me, which I like, which means this is why we gave it a good review. Despite not hitting the top line revenue growth, I think the number is, the forecast is conservative and produces 50% above average market return, which I think is a good investment idea. So I'm going to give it a good. With the caveat, there's some risk there that they need to be able to grow revenue and book value. But in the meantime, there's some cash flow there. It's a safe global bank for a possible above average return. My name is Cameron Stewart. This has been a review of Citigroup. Thank you for watching Rational Investing. If you like this type of analysis, I do teach a course. You can find that course at cashflowinvestingpro.com, where I walk you through how to value a stock, how to build a forecast, what risks to look at, how to read a P&L and a balance sheet and a cash flow statement. It doesn't focus specifically on banks. This is just an example. I look at mainly corporations that are non-bank entities. But take a look at the course, see if you like it. Let me know what else you'd like to see. This is the bank series. We're going to go through a number of banks to figure out which one we should be holding. Thank you very much for watching. Take care. Bye-bye.